Hi everyone, it's PJ Patterson here for Market Update for the week beginning the 12th of October. I believe, 12th of October. Hope you had a great weekend. It was absolutely perfect out there this weekend. Hopefully you got out and about and enjoyed the lovely, wonderful hot weather we had here in Sydney and I think around the country. But nevertheless, it was a beautiful weekend. Hopefully you enjoyed it. Top three things today. First of all, we're going to talk about the US dollar and its ongoing correlations or lack thereof with some of the other asset classes that we talk about from time to time on this market update. The second thing is going to be the U.S. election. What's going on there? We're 3 weeks out, more or less, to the U.S. election. And then finally, the volatility. I want to just touch on that again because we're, again, at a very interesting spot around volatility. There's a few other things I'm going to show you today as well that have kind of popped onto my radar that I think are a little bit interesting. And we'll, of course, see how they play out in the long term. So first things first, let's talk about the US dollar. So I am going to find, here we go. Here's a correlation table that I show a lot now because it's very important that you understand that the US dollar drives a lot of other relationships out there in investment land. And it's probably one of the key things now that I focus on in terms of its direction and where it is in certain trading ranges. And of course, this table, which shows the correlations between it and a couple of other very key and important asset classes that drive other metrics. So one of the biggies is oil and the relationship between the dollar and oil. And of course, one of the other big ones is the S&P 500 relationship between S&P 500 and the dollar. Gold would be another one that we're keyed in on. But as you can see here, we continue to see pretty strong correlations and they're negative correlations between the dollar and the S&P 500, the gold, and of course oil. Now that has deteriorated slightly with oil over the last 90 days, 30 to 90 days, but again could pop very quickly back into being highly negatively correlated. It just isn't at the moment highly negatively correlated to the dollar and its movements. Obviously the oil market has other things involved in it, supply and demand metrics and OPEC and the stuff they do, but the key driver is the dollar. But here's the thing I really want you to focus on. First of all, and I don't have a table of this, but the US dollar has been making a series of higher lows. So this is the US dollar index I'm talking about, which is a trade weighted index, has the euro and the pound and the yen and the other the Aussie dollars in there, but only at a small amount. But anyway, the US dollar index has been making a series of higher lows. Now, this is important because the dollar is definitely in a bear market trend at the moment. But what you can have are periods where it runs counter trend, and these can often cause certain developments to occur in markets that need to be paid attention to, basically. And so my point of continuing to drive this home and continuing to talk about it for you is because the US dollar, again, occupies a pretty important space in the global macro setup. And so because we are at the moment teetering on a quad 4 setup in the US, that is a strong dollar setup and a strong dollar quad. So it's just interesting, and I have talked about this in previous updates, but it's interesting that quad 4 is looking more and more likely in the US, and the dollar is giving us a signal that that is the case. Anyway, it's just a relationship that I am continuing to pay a lot of attention to. Over the last probably over the last 7 to 10 days, we've seen a lot of talk about this new stimulus package that Congress and the president are trying to negotiate. They're talking about 1.8 trillion, but there's a lot of political backing and forthing going on. And the market, my point of bringing this up is that the market is effectively pricing in that some sort of stimulus package is going to come down the pike, and it likes it, right? So it's pricing it in, and it's trading higher on this enthusiasm and this hope that that's going to occur. Now, as this has dragged on, it's looking less and less likely that a stimulus package is going to occur. So that's going to be bad for the U.S. stock market, and could be bad this week for the U.S. stock market because, as you can see from this headline on the screen, they're still sort of disagreeing around a deal. And if this deal doesn't happen this week, then we're going to see, I think, the stock market in the U.S. come off quite a bit. Now, what that means, I don't know. We'll just wait and see what happens when we get there. But it could be anywhere between a 3 and 5% correction. Now, that's obviously going to have impacts on other asset classes, and it could very well deteriorate from there as we head into the election cycle as well, which is point number two. But just before I move on to the election, again, I am very much watching these correlations, watching the strength of the dollar, and watching the behavior of other asset classes. Gold has been acting a bit funny. The dollar's obviously been moving higher, and I'll get to volatility in a minute, but volatility is still elevated. So quickly on the election, November 3rd is the election, and of course it's also Melbourne Cup Day, so we could have a very interesting day here in Australia and around the world, of course, with the U.S. election. I don't really have a horse in the race. I don't really care whether Trump wins or not. I mean, I'm not really that keen on Biden. I think he's a socialist at heart, and I think he's going to really torch the U.S. dollar. But they're both going to torch the dollar ultimately, which means the people in the U.S., their cost of living is going to rise. But look, ultimately, it's the same shit show no matter who's in charge over there. So, again, it's not really going to matter who wins. I suppose, well, if I had a preference, I'd probably like to just see Donald Trump stay there because I think on balance, he has been better for the U.S. than a Democrat would have been, certainly in the way he's approached China and kept the U.S. out of foreign entanglements, wars, etc., which has been good. But again, it doesn't really matter who's in charge. As I say, it's still going to be a poo show. Anyway, that'll be interesting. So we've got 3 weeks basically to the election. I think there's going to be a heightened amount of volatility that's going to creep into the markets as we approach the election. You may or may not recall, but on election day 4 years ago, when it was looking like Trump was going to win, the stock market sold off by a huge amount. I want to say it was down 10% or something like that, 11%. It was just massive. And then all of a sudden, I think people worked out that he was actually going to be really good for the U.S. economy. And it then reversed all of that and went up by a reasonable amount. So it was a crazy, crazy swing day. I have no idea what's going to happen on the day. We'll just wait and see what happens when it arrives. But just to move on to volatility and a couple of things to highlight here. Volatility of both the S&P 500 and the NASDAQ continue to be in a regime that is elevated and making it difficult to be able to invest in certain things. Now, it has come back this past week. Again, I think it has to do with most traders and other institutions and things like that positioning themselves for some sort of stimulus package. And if there's disappointment there, number one, we're going to see volatility spike, and number two, we're going to see the market sell off. We'll also probably see, again, the U.S. dollar strengthen, and we'll see a whole other raft of things occur. Treasuries and other instruments should also get a bid, and they'll go up. People will probably move to a slightly more defensive posture. So Quad 4 portfolio is very defensive, and that is exactly the way I'm sort of positioned at the moment. I'm raising some more cash in portfolios. I'm just anticipating this a bit of white water, if you will. If any of you have ever been whitewater rafting, there's going to be a little bit of whitewater ahead. And as I consistently have been saying to you in a lot of these updates, my primary mission for looking after our capital and our money and your money and my money is to preserve it, is to not have any big drawdowns of our capital. This is the thing that kills people in their portfolios. Yeah, sure, it's great to see a 5 or 10 or 15% return on your portfolio, but it doesn't matter if you get a 15% return if it's following a 40% drawdown in your capital. This is the thing that people don't understand about the maths of it all, is that once you get to about a 20% or 25% drawdown, you have to have a 35 to 40% or more uplift to actually even get back to being square. So the key thing in this business of managing money is to not lose it. So again, we're in unprecedentedly volatile and strange times because of all the factors I've sort of just talked about. We've got the election, we have the U.S. dollar doing some weird stuff, and of course now we've got a headline today that North Korea's got some new nuclear weapon. So who knows what that's going to do? I think people have probably started to ignore them unless they actually fire one of these things at somebody, even as a test missile. Probably won't send too many shivers through markets, but still, it's another one of those things that's floating around out there that could be a black swan. Let's say North Korea wakes up one day and fires one of these new, if they even had it, but fires one of these ballistic missiles that shoots it towards Japan or towards the U.S. and it lands somewhere in the Pacific Ocean close to something important. Well, that's going to send some tremors through the financial markets. Anyway, hopefully that won't be the case. But just to lock it off, a couple things to quickly share. I got this really interesting report from QBE on housing, and something jumped out at me. First of all, hopefully you can see this on your screen, but one of the metrics that has concerned a lot of people in the property industry is the amount of migration that we're having to this country, because that's one of the big drivers of house prices here. And as you can see, migration has fallen, right? So we're down 16.
You've been listening to the Money Matters podcast. Thank you for joining us. If you liked the content that you've heard today, please subscribe to the channel. And remember to leave a comment, like, and share it. Thank you for joining us. We'll see you next time on the Money Matters podcast.
It's just something I'm highlighting. The other thing that I thought was interesting was employment growth, of course, is down. We knew that already. This other metric here, housing affordability, despite the fact that we had basically had a depression for a couple of quarters, we're moving into that recessionary recovery now, and hopefully a recovery. We're still seeing housing affordability plummeting in Australia. And I just don't get it, because you would have thought that a circumstance like what we've been experiencing in the last 9 months or so would have had a negative impact on housing prices. It's actually done the contrary. Now, as I've mentioned before with the budget stuff, and by the way, the budget was pretty good. I thought it was pretty balanced. I mean, obviously there's going to be winners and losers, but clearly what the Australian government is trying to do is boost employment, and particularly employment for young people, and I think that's probably a good thing. So remains to be seen the impacts of all of this, but I certainly think in terms of the budget, they've fired the bazooka at the market. I suspect we will see the RBA cut rates on November 3rd. They opted not to, for whatever reason, on the last meeting, whenever that was, October 5th or whatever. And so we'll see if they do it on November 3rd. I guess they probably will. The market seems to be pricing that in for Australia. So again, it doesn't really matter whether they do or they don't, because we're at 0.25% of the cash rate. They'll cut by 10 to 15 basis points. I don't think they'll go to zero rates. That would be probably a little bit scary. But anyway, we'll see what they do ultimately. And that's really about it, I think, in terms of some of this housing stuff. But I'll continue to watch that market. It's not something I'm following terribly closely, except for the property development stuff that I do. And that was just predominantly in Queensland, which apparently right now is just going gangbusters. We have a lot of people taking advantage of the first home deposit schemes and a few of the other government schemes that are being supported and funded. So anyway, is what it is. All right, I think that's it. If you do have any questions about anything in the update, please shoot me a comment. Let me know about that. And as always, I'll keep an eye on things like volatility and everything else. Let's see how the market opens up in the U.S. Overnight on Monday night, and obviously watch it this week to see how things unfold. Until the next update, have a great week, and I'll talk to you soon.